Hello, hello. Thank you for joining today. I'm Preston Williams. I'm a local realtor in the Memphis, Tennessee area, and I specialize in just helping buyers understand the buying process and achieve their goals of home buying along the way. And if you're watching this, it's because at one point you either have thought about buying a house, you plan on buying a house in the future, or you are currently looking for a house and you just need a little bit of pointers of where to go with it. So what we're gonna do here, even though this is called Home Buying 101, I don't want you to think of this as a class. It's not a class. It's more of I guess we can call it a guide to just what the home buying process is, what it all entails, and what you should expect along the way in order to help you make informed decisions and not get overwhelmed with everything that goes into it. And we're gonna start at step one of how to prep yourself to buy a home, as in your mortgage. So we'll start at step one, which I'm gonna call a self-assessment.
I need a house in the hills that come with a deck and a grill. So all of my niggas we been cooking for real. I gotta get back to the real. We gotta get back to the field. This all my people is looking up still. Said I need a house in the hills.
Self-assessment. This is where we're going to take a step back and look at financially where we are in our position to buy a house. Unless you're buying a house cash, you're going to have to get a bank loan, and there are certain things that the bank will want in place, and we're just going to look at where we are as far as being able to qualify for a mortgage. And the first thing we're going to talk about is your income. Now, income can be very simple or very complicated, but it depends on how you make money and where you make it at. The easiest way is if you are a W-2 employee, meaning you have a job that pays you a regular salary or by hour, and you get a paycheck weekly, bi-weekly, or monthly. That's the easiest way to calculate income, and you're able to know exactly how much the bank will calculate as your income. So the easiest way to do that is to look at how much your pay for the year is, annual salary, and divide that by 12. That will give you your monthly amount. If you are an hourly employee, then you may want to look at your past a few payment periods and calculate your average monthly income. Now, if you have a lot of overtime just in the recent months, and it's not a regular thing that happens over the course of the whole year, then you do want to think about the fact that the bank may not account that as regular income, which means it would not help your pre-approval amount. Will help you save money, but it may not help your pre-approval. Now, if you are a self-employed or a 1099 contractor, then that means that your income is actually directly from your taxes. They're not going to look at how much you made on like a 1099 or your sales in your business. What they're going to look at is your taxes. More importantly, they're going to look at your adjusted gross income of your taxes, which means that if you made $100,000 for the year, that's your gross income. But that's not what they're going to count. They're going to count your adjusted gross income, which means if you claim a lot of deductions on your taxes, then that's going to lower the amount of income the bank counts. Now, meaning if you made $100,000 on a year and you claim $30,000 in deductions, then $70,000 is what the bank will count as your yearly income. Now, to also take that a step further, the bank will not just look at 1 year. They will look at a minimum of 2 years, which means they'll look at the previous year and your last year taxes of what your AGI is, and they literally combine those numbers and divide them by 2. And that's what they will count as your adjusted gross income. And that is what will go towards your DTI and your pre-approval amount. Now, if you have a side business, a side job, or things like that that's done like under the table, or just you having your own business, you want to make sure that money goes through your bank account, because they will look at bank statements as well. You want to make sure it goes through your bank account and that it's also being counted on your taxes. If you are a W-2 employee who makes a regular paycheck, and you have a side business of beads. You sell beads, and you made $10,000 on that last year. But that money was all cash. It didn't go in your bank account, and it also did not get claimed on your taxes. Then the bank will not count your bead money as actual income. They're gonna count that as, well, honestly, they're not gonna count it as anything. It may be in your bank account, but they're not gonna count that towards your pre-approval amount. You wanna make sure you take any money has a paper trail of how it got in there. Also, if you just have a lot of cash on hand, you want to put that on in your bank account before you go to get pre-approved. The bank want to know that your money is, I guess you can call it aged, that it's seasoned. It's been there for a while. It's not just you had $1,000 in the bank on Monday, you put in $10,000 on Tuesday and went to get a pre-approval on Wednesday. They want to know that the money has been there for a while and it's seasoned, I guess you can say. It's aged in your account. The bank will ask for a minimum of 3 years or 3 months of bank statements. That's the thing to keep in mind too. So you want to keep your spending down right before going to get a pre-approval, and you want to make sure that there's not any random large amount of cash being put into your bank account. Now, let's go on and look at the other half of the spectrum. We've looked at income, let's look at debt. So debt is not the same way that we calculate it. Just how with income, things we count as income may not be income in the bank eyes because it's not documented a certain way. That actually plays to our benefit when it comes to debt. Now, when you write down all your bills, you'll have your phone bill, your furniture bill, your car insurance, your car note, whatever else you have, and your cable bill, your internet bill. You have all these bills, and it looks like your debt is extremely high, but that's not actually what the bank looks at when it comes to debt. The bank actually looks at what is reported on your credit and what is what I like to call unavoidable. Like your car note, you can't just not pay your car note. You can't go out and cancel your car note. You can't go out and cancel your student loans. You can't go out and cancel a personal loan. Things that aren't able to be removed is what the bank will count as debt. So like things like your cell phone, your car insurance, those are things that you need to have, you want to have. But if times got hard, you can let your cell phone go and save that $100 or $50 or whatever dollars a month. You could let your car insurance go and save that, whatever it is a month. So those are things the bank does not actually count towards your debt. They look at hard debt, things that can't be removed, and things that are reported on your credit. So you'll want to look at your report and look at the balances on there and look at what is actually being counted as open lines of credit on your credit report. Now, once you have your monthly income there and you have your monthly debt, you're going to want to divide your debt by your income, and that will give you your DTI, your debt to income ratio. That is a ratio that the bank uses to help qualify how much of a home you can afford. Now, ideally, your DTI will be no higher than a 20% ratio, which means that 20% of your income is going towards your debt every month. That means you have 80% of income that's just open, free, and you're able to place wherever you want to place it. That doesn't mean you have to have a 20. There are loans that will allow you to purchase with as high as a 40% DTI, but the lower the better, and it also helps you to plan financially if you plan to keep your DTI low. Now we'll talk about credit. So credit is a thing that's not easily adjusted. It's not a quick fix, as a few of the other things may be. But you want to make sure your credit score is at least around a 620. ideally a minimum of 640. There are programs who will allow you to buy with the 620, and there are even programs that will allow you with a 580. But you want to ideally have at least a 620 to 640. The higher the better. As the higher, depending on the loan type, it allows you to get a better rate, a better interest rate, which saves you a lot of money, because a compound interest is a large fee over the course of a 30-year mortgage. Now, if you're wondering what your credit scores are and you're not really sure, you don't want to go to like your credit card app or Credit Karma or a thing like that. You want to go to a place that gives you your actual scores directly from the bureau. The easiest way to do that is going directly to the bureau and getting your free credit report. They are obligated to give you one at least once a year, and you do want to take advantage of that and get your actual whole report. That will help you in a lot of different ways. One, it gives you a way to look at what debt is being claimed on your credit. So if the debt's being claimed on your credit, then it's a high likelihood that the bank will count it as debt. You're able to look at your balances and things like that. You're able to look if there's anything on there that is a negative on your account. If you do have items on your account that are negative, you do want to get those removed, paid off, or whatever you need to do that's easiest on your end to get that negative account removed or turned positive. I recommend that if you have those, speak with a credit specialist about what your options are as far as handling that account or those accounts. So now, once we have all this, we have our income, what the income is, what our debt is, and we know what our credit is. Then we're kind of able to see, do we qualify for a house? We're able to look at, do we have the income and the debt ratio to qualify for a house? Are we in a good place with that? Do we need to go back and eliminate some debt, or do we need to raise the income? And then we're able to look at our credit and see, is our credit in a place to where we can buy a house as well? So that's step one, just taking a step back and saying, hey, can I do this now, or do I have things to work on? If you have things to work on, then you're able to make a game plan. You're able to write down what you need to do and start to mark those off the list. Just mark them off the list. And if you are ready, then you're able to move on to step two, which is getting your pre-approval.